Okay. So now today we are discussing about types of bonds. So convertible bonds are the ones which can be converted into equity in the future. Okay, that clause is there along with the bond. Whenever the issuer issues such kind of bonds, they really know that the convertible clause is there, and it's a very advantageous provision for them because whenever they want and whenever they have money, they can or like it's good for the shareholders also, bond holders also, because they receive fixed interest during the beginning, and then when the bond is converted into equity they get dividends. Okay, they get ownership in the company. Debenture bonds are unsecured bonds. That means there is no security or whatsoever for this bond. This bond is basically on credit ratings. So top companies, the companies which are very strong, okay, which have never defaulted, or like there's no chance that they would default, and they're doing exceptionally well. So those companies, if they want funds, they can issue debenture bonds. Fine. Since the risk is high because there is no security for this bond, that means these are not asset backed bonds. No asset is kept as collateral for this. Since the risk is high, the interest rate would be high. Okay, the investors can enjoy high interest rates. Mortgage bonds are nothing but the bonds which are which are the bonds based on the mortgage of assets, or mortgage bonds have specific asset or assets pledged as collateral for loan. Okay, so for example, the assets pledged as collateral make the bonds less risky to investors, because suppose this is an investor and this is a company has issued bonds to the investor, and those bonds are having the backup of assets. Okay, which assets? The mortgage, mortgaged properties. For example, this is a bank. This bank has lot many people who have approached for loans. Let's say housing loan. So housing loan is the one where the bank can give funds to the borrower when they pledge or keep their properties title deeds as collateral with the bank. What will bank do with those assets which are pledged or mortgaged? They will convert them into securities and sell to people as bonds. So those bonds become mortgage bonds. So there's less chance, even though there's less chance of having a high risk on these bonds, even though the banks which have issued these bonds, they default, the bondholders can sue them and drag them to the court of law, and can claim their money by selling the assets of the company. Now subordinated debentures are the ones, are the ones which come under the senior bonds. So I would say subordinated debentures are junior bonds. As you know, these are debentures, they don't have any security. That means they don't have any asset backup to them. But senior bonds are something which are having asset backup, and the first claim is like whenever the company repays, they first repay to senior bonds, and after repaying them, they go for junior. Why? Because company has committed here that they will repay, and company has an obligation here. Okay, otherwise company has to sell the assets and repay them. But in case of junior bonds, the security has not been given. It doesn't mean that company won't pay. Company would pay definitely, but they would pay these guys after these guys. Why? Because company is bound here and it's not bound here. Income bonds pay interest only if company achieves a certain level of income. Suppose company has promised that if company makes a profit of $1 million, company would pay the share of company would pay some share of profits to them. Okay, so income bonds pay interest. Let me say, I'll not say that point, I'll just give it in such a way. So company will pay the interest, of course, only when a company achieves, or like company uh, touches the target what they have set. Suppose let's say the company has set a target of $1 million. So when company achieves $1 million, they pay interest to bondholders. Okay, so these are very riskier ones, but the bondholders get a very high interest rate. Serial bonds are bonds issued with varying maturity dates, so that some of the bonds mature each year. So every year they mature, and those are called serial bonds. Serially they mature. Okay, and the issuer of the bonds is thereby able to retire the bonds a little at a time over a period of years without the need for a single large cash payment. So that is the benefit of serial bonds. That means the payments are done serially, and slowly steadily they set off, or they kind of pay off their liabilities, who the companies or the borrowers, and instead of making a lump sum payment at the end. Fine. So whichever investors are happy with these kind of bonds can go for them. Zero coupon bonds are the ones which do not pay any coupon, any interest. But what happens? You get good returns from them. How? Suppose you bought a bond. Suppose a bond is issued at $1,000. You bought it for $950. Generally, what happens is zero coupon bonds. They do not pay coupon, but the bonds are usually issued at discount and redeemed at par. So issued at discount of $50 and redeemed at par. So here, 950 is what it is issued at, and the repayment will happen for $1,000. So how much the investor has made in between? $50. On what? On their investment of $950. Can you tell me what's the answer for this? Hello, Smriti. Can you tell me? Can you find it and tell me the answer? Hello,
Hello. Yes,
hello.
sir. One second.
Yeah,
Hello.
yeah. Hello. Why it's taking so
Hello,
much
sir.
of time?
Hello, sir. Yes, sir. No, sir.
No,
I
yeah.
have to
What?
get my calculator. Sorry.
Okay.
5.60.
That much they have made the returns. Okay. Now, then comes the participating bonds. Can participate in dividends of the company during a period of high profits. This is the special feature they carry. Indexed bonds have interest rate that is indexed to some other measure. Suppose like they have linked the interest of this bond to the what we say, like wholesale price index or retail price index. That means if this is becoming is if this is rising, that means more inflation, more costly the things are going, so interest would be paid higher. Okay, so it depends, like if this goes down they pay less interest, if this goes up they pay high interest. So like the payment is not fixed, it's like variable interest rate. Default risk of the bonds, of course, there is the default risk at time seen. If I speak about, just a second, Smriti. So if I say something like what we say, treasury bills, they do not have any default risk. So the returns would be very less. But ABC companies bonds, ABC Inc. Let's say, this has a very big risk of default. Why? Because it's a private company and no asset backup. Let's say, then even we cannot say that they will not default. Whether they will make profits or not, it's a big question mark. And their rating is also given as triple C. What do you mean by triple C? It's a highly risky bond, so you demand higher interest rate for such kind of bonds. Okay, so you have to do these questions. Like, can you tell me what's the answer for this question?
Hello. Hello.